Hey everyone, welcome in to another daily editorial here on the KE Report and a special Sunday daily editorial as we are chatting again with Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark to Market website, which I will link to in the show notes. Marc, we are chatting with you off mic, and your main theme here is the next couple weeks are going to be very busy, economic data wise and even market wise due to different meetings, different data, and some large US bond auctions coming out. So, as much as maybe this last week was a little bit quieter, we saw some more muted market moves, a lot of people more focused on early earnings reports. Lay down the road work for us in the next couple weeks. What could be market moving? What matters in your eyes?
Sure, yeah, thanks. I'd begin off with like sort of initial conditions. The dollar has risen for 4 consecutive weeks. And that's how we're going to begin the new week. And this is going to be, I think the next 2 weeks are going to be the most tumultuous that we've had in the capital markets. I know we had that experience with the unwinding of the yen carry trade earlier this year. And of course, that was some of the amazing moves, how quick they were. But I think these next couple of weeks are going to be just as stressful for investors. It begins off Sunday, today, with the Japanese elections. The LDP, what's funny is that the LDP, the Liberal Democratic Party in Japan, has been governing Japan more or less as long as my birth city, Chicago, has been run by the Democratic Party, roughly since the mid 50s. And the Japanese, the LDP, has fallen victim to an internal funding scandal that has weakened it. And some polls suggest it might not get an outright majority. And even with its current coalition partner, it might not be sufficient. They might have to bring in a third party to join the coalition. So that'll begin off as we kick off the new week. But the new week also features, we've got the UK budget on October 30th. That's very important as well. This is going to be the first budget of the new Labour government. And they're going to be austere, that is tight fiscal policy when it comes to day-to-day operations. But where they're going to differ from the Tory party is they're going to recalculate how they sort of figure out the size of the budget deficit, and they're going to rejig this and basically create more space for new public investment. Then, as the week progresses, we get the Bank of Japan meeting. They're unlikely to do anything. I feel very confident that they won't do anything. After that big turmoil that they triggered in July, they'd want to signal a move, and they haven't done so, despite the dollar getting back above 150 yen, which some people thought would bring forward the Bank of Japan's rate hike. As the week progresses, we're going to get the Eurozone's October CPI. And of course, the low CPI readings helped spur the ECB into cutting rates earlier this month. But now we should expect a small uptick, which will likely dampen this talk of a 50 basis point cut in December by the ECB. The U.S. employment data sort of finishes the week on Friday. And here I think we should be prepared for a dramatic slowing of job growth after the 254,000 in September. The Bloomberg median forecast is for about 120,000. And if it's wrong, it looks like it could be even weaker. Partly, of course, it's not going to be a clean number because of the storms and the industrial action, that is the strikes that were taking place. So the other thing, and that's what you had mentioned as well, Corey, what I was pointing out is that next week, the U.S. on Wednesday will announce the refunding, how big of the refunding package. But even as they do that, the U.S. Treasury is going to be raising between bills and coupons more than $500 billion next week. So I think this is what happens, is that we've seen this big backing up of U.S. interest rates, and I think that will help make these auctions, over $500 billion worth of auctions, go relatively smoothly. And that might mark the top in U.S. yields. Just like when the Fed cut rates, U.S. yields more or less bottomed. Similarly, after all this supply is dumped on the markets, I think that might be the beginning of a recovery in the U.S. Treasury market, which in turn could mean that the dollar's rally has one more leg up in the next week and then just about over.
Mark, I was going to ask you that with if you expect rates to come down, how does that affect the dollar? Because they usually do move somewhat in tandem. But also, what would be the impetus for such a big bond buying, program? And do you think that other foreign nations also participate? What's the health in your eyes of some of these recent bond auctions, and what do you anticipate for this one?
Yeah, I think that we really haven't seen large scale foreign selling of US Treasuries. And I think that partly it's that the role that Treasuries are in the world economy. First, they offer a yield premium, a yield pickup for many savers. Secondly, remember too that one of the big sort of memes that have emerged this year is that the U.S. is spending more on interest payments than it is on defense. But where do you think that money from the interest payments that they make goes? It goes to us. Most of U.S. Treasuries are owned by Americans, whether it's through the Social Security, whether it's the Treasury the Fed has, but a lot of us American investors have been also buying more Treasury paper, bills, whether it's directly or through the money markets, or through bond and our other savings vehicles like our 401ks. Americans own the Treasuries, so when the government pays the interest, it's coming mostly to us. And I think that I think is important. So I'm not worried that there's some kind of boycott against U.S. Treasuries, even though the BRICS meeting's taking place. And I would take the BRICS more seriously about a dollar challenge if some of the key members did not tie their currencies to the dollar. Like, for example, Saudi Arabia sort of hasn't decided whether to join yet. But of course, when the Federal Reserve cuts rates in early November, so will Saudi Arabia. So will Hong Kong Monetary Authority. So I think that a lot of this de-dollarization and BRICS talk is just talk. But more generally, that the interest rates, that it oversimplifies it a little bit, but I think the dollar does track U.S. interest rates fairly closely. And we could talk about which interest rates. For me, the Japanese yen is more of a function of the U.S. 10-year yield. The euro is more a function of the U.S. German 2-year interest rate differential. And as we're talking here today, Canadian dollar remains under pressure. And I think it's approaching a 2-month low for the Canadian dollar. What's happening is that U.S. interest, Canada just cut 50 basis points. And the interest rate differential, the 2-year Canadian discount to the U.S. is over 100 basis points, the most since 1997. So I think that the interest rates might not be the whole story, but it gets us pretty close to what's happening in the FX market.
Mark, how do you analyze these bond auctions? There's so many of them, and we hear sometimes it's above the bid, it's below the bid. Foreigners took this much, dealers were stuck with this much. What actually matters, or does it actually matter to analyze these bond auctions?
Yeah, I mean, I think it depends on like where you sit. So there's generally a few metrics that people judge the bond auctions on. Bid cover, and because the U.S. bonds, I mean, the primary dealer system, it basically rules out a failed auction, which sometimes some European countries have had. And a failed auction would be where there's not enough buyers. But you can see that the U.S. auctions typically are oversubscribed, partly because primary dealers have to participate. There's also, before the bond is actually sold, it trades in what we call a when issued market, WI market. And so people are comparing that interest rate that's in their when issued market to what it actually is auctioned at. And that could produce lower or higher. And that also indicates sort of the underlying demand. The other thing we watch carefully is who ends up buying them. So you've got direct buyers who buy directly from the Federal Reserve. You've got indirect buyers, and then indirect buyers would include pools of capital such as foreign asset managers, foreign central banks, large U.S. asset managers show up in the indirect bids, and that gives you also an idea of of who's buying. And then, of course, how much is left how much do the dealers have to buy themselves? If the indirect and direct participants buy up the bulk of the auction, then the dealers themselves have little inventory. If the dealers are stuck with a large inventory, they do what other businesses do when they have a large inventory. They mark it down, meaning higher interest rates, lower price. So I think that the auctions are, for many investors, auctions are probably too much in the weeds. to really like influence investment decisions. I think for the large institutional players, it might help influence, that afternoon's price action rather than trends.
Well, Mark, we've talked about this a couple times in the past, but I'd just be curious to get your thoughts on there's certain time periods where the US dollar is tracking what's happening in interest rates, what's happening in the bond market, and it's really tracking the financial health of the US. But there's other times where some of that, kind of primary focus is swamped by different currency pairs. So when you went through earlier all the different banks meeting, the Bank of Japan, Bank of England, the ECB, how much do those currency pairs ever swamp the U.S. data? How much of that should play into people looking at which way the dollar could move?
That's interesting. I think that the markets typically respond more to surprises than as expected developments. So next week, if the Bank of Japan were to raise rates, the markets would respond to it because it would be a surprise. If the LDP loses, that is that they're no longer leading the government in Japan, that would be a shock, and the markets would respond to that. So typically, I think that's really more a question of what comes out of what versus expectations. But most recently, I think when you have large moves in the market, I often see sort of both blades of the scissors moving. So, for example, the market, just as the market decides that the Fed may not cut 75 basis points before the end of the year, like it thought as recently as late September, early October. Same time, that's the market's pulling back sort of the aggressiveness that had been pricing in for Fed cuts. They're pricing in a little bit more aggressiveness for the ECB. In fact, there's about a 40% chance in the swaps market that the ECB cuts rates by 50 basis points when it meets again in December. So sometimes, and I think oftentimes with big moves in the market, you have both blades of the scissors moving, so to speak.
Mark, I find it interesting. There are central banks out there that are speeding up their rate cuts. As you said, Canada just came out with a 50 basis point cut. Expectations are for other countries to continue cutting rates probably more consistently than the US, but then the US started with the 50 basis point cut. Where do markets stand right now? Which central bank, in your eyes, or do you see the market continuing to price in the most aggressive cutting? And where does the US fit into the globe?
Yeah, so I think that partly, the Bank of Canada cutting rates so aggressively this year, and like you said, it was 3/4 point cuts and now 50 basis point cut. That in effect, they're front loading the rate cuts so that next year, while the market's pricing in about 130 basis points from the Federal Reserve, is pricing in about 95 for the Bank of Canada. So I do think that the market has the view now in the swap market and the derivatives market is that the ECB is going to be more aggressive in cutting interest rates. And aggressive is not just sort of the path that they're on, but also their destination. And by that, I mean that there's been increased talk that the ECB will have to cut rates below the equilibrium level, which is seen to be around 2%. I think this is pushing it a little bit. I think they're going to be moving in that direction. But I think that you're right that the market is beginning to price in more aggressive actions. Bank of England, Governor Bailey spoke earlier this week, and the market has no doubt that the Bank of England is going to cut rates 25 basis points when it meets in early November. And it's still pricing in a good chance of a follow-up one in December, after they've only cut rates a couple times this year as well. So I think that the U.S. is not seen anymore as the most aggressive central bank, despite its 50 basis point cut. Like you mentioned, Canada's cut 50, New Zealand's cut 50. Now, of course, like I mentioned, the speculation that the ECB cuts by 50. So I think that with the market, broadly speaking, and I think this is where what data dependency means, is that the general course of the G10 interest rates, leaving aside Japan, is for lower interest rates. And this year sort of was a down payment towards it. And we'll get more, the monetary easing cycle will continue through next year and likely into 2026.
Mark, I'd just like to get your thoughts on whether the central banks in the G10 should be so aggressive with cutting rates. There's been a lot of financial critics in the mainstream media and even people on our show that said they should save some of these bullets in the chamber for when they really need to use them, because in the past cycles, cutting rates was a policy, it was a monetary policy tool that they used to kind of calm the storm. And right now, the markets are actually in pretty good shape. The economies are not falling out of bed. Inflation's come down. Should the central banks be so aggressive in cutting rates, or should they keep some of the bullets in the chamber, like many have mentioned?
I think that this is where I think that a concept that we use on the institutional side that retail investors often struggle with. That is, even though it looks like rates are high, yet when you adjust for inflation, that is to say, I find that the retail community and even a lot of our small, medium-sized businesses, they talk about nominal interest rates. While the real policy signal or the real impact on the economy comes from the inflation adjusted, that is the real rates. And so I think that so far, what most central banks have done is not really ease policy, even though they've cut interest rates. They've cut nominal interest rates. What's happening is that real interest rates were very high. And as inflation falls, those real interest rates get higher. Think about that, right? As inflation falls, the real interest rate has gone higher unless the central bank cuts rates faster than inflation's falling. You can make a case, perhaps, that Bank of Canada has cut rates a little bit faster than inflation's falling, but not by much. And so I think that interest rates, inflation-adjusted interest rates, are still what central banks would regard as restrictive. That is, at the level of real interest rates is above what they think is a long-term sustainable level. And I think what that means then is that the easing cycle has to continue as long as inflation's falling. If you don't cut interest rates in a falling inflation environment, in effect, you're forcing your economy to deal with higher real interest rates. And I think that, of course, as investors, when we buy a bond, we're getting nominal yields. I get that. But when you're trying to think about how interest rates are affecting the economy, you have to really adjust those nominal rates for inflation.
That was going to be my question next. But okay, you give us something to watch here. If inflation stays sticky, like a lot of people think, then I guess we should be expecting central banks to slow their rate cuts and let the current cuts filter through the system. But let's talk about the current cuts and even some of the future cuts that are coming. In your eyes, how do these impact the economy? What economic data is most impacted by these lower rates, even though inflation is lower, or market segments? Which markets are most impacted by these lower rates?
Yeah, so first I began with lower rates. How does it filter through the economy? So I think that the sensitive sectors tend to be those like housing, auto purchases, consumption, not so much in the short run. But the first markets that would be the most interest rate sensitive markets seem often to be the housing markets, markets in which people have to borrow. Secondly, I'd say that what happens then, like as you were sort of playing this out, then what happens? How does this work for the economy? Well, typically after the housing market, that affects psychology. It affects people's willingness to take other risks. You would think that the stock market would do good in a rising interest rate environment. But lo and behold, as we all know, the U.S. stock market rallies to record highs when the Federal Reserve was raising interest rates. Federal Reserve cut interest rates, and the stock market still near or at record highs. I think that, when you think about why is the Fed cutting interest rates, why the central bank cut interest rates, again, it's not so much because of the current view of the economy, because of the lag time with monetary policy. What they're really doing is trying to adjust interest rates to where they think the economy is going to be in 3 or 6 months or something like that. So because of the lag between the change in monetary policy, change in the economy, when the Fed cuts interest rates, you would think, oh, let's go buy stocks because we lower interest rates. But the reason the Fed's cutting interest rates is because they're concerned about the economic outlook, which says something about pricing power, says something about demand for these businesses whose stocks we think we ought to buy in a lower interest rate environment. It's really about a process. And I really think that your vision of it, of a cycle, makes sense to me. That certain parts of the cycle, the lower interest rates are good for the economy, are good for the dollar, are good for risk assets. But other parts of the cycle tend to be less so. And I think that the hard thing for investors is one is to see things cyclically as opposed to linearly, like we see most of our lives, and to appreciate this lag time that it takes between monetary policy triggering something and when the announcement is first made.
Well, then, Mark, to that point, if they're using the fact that it's a lag effect and they're trying to place the rates where they think the economy will be in the future, should the general markets and so many people have gotten all jacked up on these rate cuts? Because remember, that was the Powell pivot party. That was people excited about lower rates mean, hey, oh, good, lower cost of capital, good for the small caps, good for the stock market. Have investors gotten a little over their skis looking at it linearly and looking at it as just all a good thing instead of looking at it cyclically?
Well, I think that's what the market is telling us, right? That I think that the market still is rewarding those companies. When you think of the Magnificent Seven or however you want to define them, they've also had very strong earnings data. Most companies haven't. I want to say it's something like a third or 40% or something of the Russell 2000 are struggling. And so it makes sense to me that it seems to me rational for the markets to concentrate on a few stocks that have stronger earnings rather than the whole market that might have weaker earnings. So I'm not so sure that the market's being so irrational here, though. I think value, I see how the stock market is even coming back. We're still down on the Dow is down over 2.5% this week, but I see how Nasdaq's up 0.5%. S&Ps are down about 0.5%. Market is focusing on where the earnings are strong and the potential is strong. I think I agree with you. I think the market has made some exaggerations here. I think there will be that those events that we were talking about, including the U.S. jobs data, I think will be like another sort of yanking on the leash, getting prices back closer to, say, underlying value when people can appreciate the U.S. that September jobs data was a bit of a fluke, and that the Federal Reserve is still going to be cutting interest rates.
Yeah, I think we all know that jobs data is going to be an anomaly, but I think that's why so many people look to the 3 and 6 month averages at the very least. Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Mark II Market blog. Always a pleasure chatting with you, Mark. Thank you for taking time with us on this Sunday. We'll chat with you next week, right before the election. Boy, oh boy, there's going to be a lot for us to look ahead on. Thanks again for your time, Mark.
Thanks. Good luck to everybody.